Good afternoon and welcome to ProVise Management's webinar, on What's Next, Mr. Biden. My name is Susan Washburn. I am a senior financial planner, and today Ray Ferrara and I will be addressing this topic. We have had an outstanding feedback, and we have a lot of people signed up for today's event, over 100. So as people continue to enter the Zoom event, what I thought I would do is go over the format with you of how we will proceed. So to start with, a few weeks before the election, we had a webinar where we discussed and compared and contrasted what would a Biden presidency look like versus what would a Trump presidency look like. We noticed that the two gentlemen as candidates both proposed different paths to prosperity for Americans. We now have more information. We have a president-elect, Joe Biden, and that brought Ray and I to the question, what's next? And so this webinar was born. What we will start with doing is I'm going to have Ray spend 10 to 15 minutes outlining the political and economic landscape in our country right now. Additionally, he'll point out some winners and some losers. We have been so blessed with you all sending in questions that have come to your mind. And so after Ray has given his introductory comments, I will ask some of those questions directly to Ray and get his thoughts and his wisdom. We also will have the opportunity to use Zoom to send us your questions. I think in the last year, all of us have learned how to use Zoom. It's part of our culture, socially, professionally, educationally, and there's a chat box. We will have the voice of God, otherwise known as Oscar, panning through those questions as Ray and I talk. It's important for me to keep looking into the camera and not reading all the questions that we hope you will send our way. My final housekeeping matter is disclosures. I am an attorney by training, so it seems only fitting that I get this job. Today we're having a conversation. We're sharing perspectives, opinions, and none of this should be taken as legal advice, tax advice, or financial advice. We encourage you to work with your professional team. Some issues that we bring up today may be great talking points, but your professional team knows you best and what you're trying to achieve to live your best life. The final piece is we have Ray Ferrara in the house today. I have a feeling part of the great response is because he's so well known to all of us. He also has lots of pearls of wisdom. For those of you who might not know him, he is our chair, he's our CEO, he's our COO. So he's been with ProVise for over, I think, 4 decades now. The one thing that I did learn or relearn about Ray while we were putting this all together is that he did have a radio show for over a decade. So this is right in his wheelhouse of addressing the public, this time via Zoom, and answering questions. So I think I've laid out the format, and I want to get right to the reason you're all here, to talk about what's next. So go ahead, Ray.
Thank you, Susan. I appreciate that. So welcome, everybody. It's delightful to be with you this afternoon and to share some of our thoughts following the election and looking ahead to the next 60 days leading into the inauguration, and then obviously beyond that. The election's over. Clearly, Mr. Biden has become the president-elect and Senator Harris the vice president-elect. It's time for the country to come together, coalesce around our new leaders, and to look for ways to continue to improve our country and our individual lives. On the losing side of the ledger, in spite of the fact that President Trump has yet to concede, I think it's clear to most of us that he has lost the election. However, he did garner more votes than any other presidential candidate except for one. And yes, that was former Vice President Biden. And so there are those that think he will not be leaving entirely, even though he'll be leaving the White House. Some of the other losers in the election, however, were the pollsters. For the second election in a row, they got it wrong. This year, it seems that they got it worse even than when back in 2016. Here in Florida, as an example, right up until Election Day, former Vice President Biden was leading by double digits in Florida, and then ended up losing in Florida by 3 or 4%. Some other folks that lost were the Democratic Party. We'll talk more about that at the state and the local level. They had great difficulty there. The same was true in the House of Representatives, where not only did they not increase their margin, they lost seats there, which will make Speaker Pelosi a loser in this election. It's going to probably cause somebody to challenge her for the speakership. At the end of the day, she probably will continue to be the speaker, but perhaps weakened a little bit as a result of the seats that were lost. In the Senate, of course, the current count today is 50 for the Republicans, 48 for the Democrats. Again, the Democrats lost here in that they were hoping to clearly have a majority. The best they can hope for at this point is 50-50 split with the 2 seats in Georgia. With that, Vice President Harris's tie-breaking vote in the Senate would be able to control the Senate. So a lot of what we're going to talk about today is we're going to work under the assumption that the Republicans will win at least one of the 2 seats that are up for voting in Georgia right after the first of the year. As we look at what's about to happen around the country, and what did happen around the country, I should say, there was a lot of down voting that was quite different than in the past. Historically, somewhere around 75% of the people who would vote would just go down the ballot and vote Democrat, 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 Republican, 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 Republican. That didn't happen this year. In fact, the down voting by some estimates was perhaps as low as 62 or 63%. So that means that there were a lot of people who probably voted for Biden and did not vote for the Democrats down the ballot, hence the results. Gridlock will be there for the next 2 years, assuming that one of the senators from Georgia occurs. The market likes gridlock. We'll talk about that a lot today. There'll be no Green Deal. There'll be no packing the Supreme Court. There'll be no statehood for DC or Puerto Rico. There'll be no Medicare for all. There'll be no changes to the taxes. And cabinet members and judges, particularly judges, over the next 2 years will find it difficult in the Senate. If, however, the Democrats do win in Georgia, and the possibility exists, then all of these things are going to be on the table, and will influence what all of us are doing in our daily lives, let alone what we're doing with the investing in our different portfolios. A lot of talk around some of the people who might be in the cabinet. One prominent name that has bubbled up early on is Elizabeth Warren, the senator from Massachusetts, as the Secretary for the Treasury. We don't see that happening. As much as she might like to do it, the issue that exists there is that if she gives up that seat, the seat will be appointed by the governor of Massachusetts, who is a Republican and is more than likely going to appoint a Republican. And the last thing the Democrats need is one more Republican in the Senate. There's going to be definite need for compromise. A positive to be thinking about is that President-elect Biden and the majority leader in the Senate, Mitch McConnell, worked in the Senate together for 20 years. Mr. Biden worked with Senator McConnell during the 8 years that he was vice president under President Obama, and was kind of the lead for the White House in the Senate. They know each other well. They can talk to each other. They can be civil with each other. And they're going to have to figure out ways to compromise going forward. And compromise is clearly a word that's been very difficult to find in Washington, D.C. for many years, not just the past 4 years. Coming up on December 11th, the Congress, the lame duck Congress, is going to have to address a continuing resolution. If they are unable to come up with a compromise on the continuing resolution, the government will start to shut down. Now, there may be some of you who think that would be a good idea, but from an economic standpoint, that would be a very difficult thing, particularly with us facing an increase in the surge with the pandemic. We're not convinced that there is going to be a stimulus bill that's going to come out of the lame duck Congress. The two sides are just too far apart at the moment. The Democrats looking for somewhere around $2.5 trillion. The Republicans no more than $1 trillion, and they're just too far apart. What we might see happen, if not in the lame duck Congress, clearly after the new Congress goes in and Vice President Biden becomes President Biden, we may see a series of smaller bills that could be swallowed by the Republicans, and that would be very focused bills and would not have a lot of extra things packed into it. So we might see that happen. That means it'll drag out for a longer period of time. About the only hope that we might get of a small bill between now and the holiday break from the current Congress is a stimulus that would do something to help those that are unemployed, where the benefits really ran out in July and some additional benefits disappear at the end of December. Then this summer, forgetting all the other issues that will be on the table, in July, the debt limit for the United States will be reached, and the Congress is going to have to raise it. And again, we're going to see some infighting that's going to occur there within the Republican Party, the moderates and the very conservative folks trying to decide just how much to raise the debt. And of course, a lot of that's going to depend on whatever the new stimulus bill might be. At the state level, I mentioned earlier that the Democrats really lost at the polls. This is significant from an economic standpoint and from a lawmaking standpoint over the next 10 years, because more legislatures are going to be controlled by Republicans than Democrats in many of the states, and they will be setting the congressional districts within those states. Part of the stimulus bill and part of the reason that it's being pushed so hard by the Democrats is that the states are expected to lose $400 billion of revenue in the current fiscal year as a result of the pandemic. They represent collectively 11% of our gross domestic product. And without that stimulus, we're going to see less government spending at the state level, which means that will end up costing jobs, not only in the public sector, but in the private sector as well. The market is banking on a strong recovery in 2021. Clearly with the news last week from Pfizer, with a vaccine that they said was 90%, at least 90% effective. The market jumped significantly last week on that news. Earlier this week, Moderna announced that they also had a vaccine that was 94% effective, and then Pfizer couldn't help itself. Today it announced that theirs turned out to be 95% effective. So I guess there's going to be some battling going on there about who's got the most effective. If for any reason the market were to stumble and not produce the earnings that it is anticipating in 2020, we will see some significant volatility that will be occurring, and probably you can start to look for that in the first part of January as the earnings for the fourth quarter of this year, which will be low, much lower than they were for the second and third quarter. If they don't come in line with expectations, it could tip the market to go backwards a little bit. Some of the pluses for the market next year, in addition to the anticipated earnings, are the low interest rate environment that we continue to be in, and the Fed supporting that low interest rate environment. Refinancing of houses is continuing. Some cases, people are pulling equity out, spending some of that money. The housing industry itself is extremely strong. Amazingly, people's savings are dramatically up this year, and they've been paying off debt in a very significant way. All of those bode well for when the consumer, which represents 70% of our economy, really comes back into to the market. Job growth, continued job growth will be needed. And as mentioned earlier, without the stimulus, we are not going to get the earnings that were anticipated. Some of the minuses, again, involve the vaccine. What if one of the vaccines suddenly has an issue, a side effect? This will cause the market to react. What if it's not generally available by the middle of the year that is currently expected? That would slow things down. Partisanship, although there'll be compromise, partisanship is still in vogue in DC, unfortunately. And the other part, although the job growth will continue to be good, we see the unemployment in the 6.5% to 7% range right now. But keep in mind, that's only a measure of the people who are looking for a job that can't find a job. There are actually 3.7 million people who lost their jobs due to the pandemic that have quit looking for a job at this point. So that's part of the reason that the dramatic decrease that's occurred on the unemployment side. The market is relatively high on a forward-looking basis. The S&P 500's price to earnings number is just north of 22 times. This is being led in large measure by the same 5 or 6 stocks that have helped pull the market up over this past year. You can look at Amazon at 71 times earnings, Netflix at 55, Facebook at 27, Google at 29, Microsoft at 30. For a growth stock like many of these are, having something in the 30 times range is not unusual. But looking at those that are at 55, 60, 70 times forward-looking earnings, those are awfully high projections, and it wouldn't surprise us to see some of those come back to a more reasonable valuation. In fact, we had a question about Google and about Amazon from one of our viewers. Two things I would say. First, we try to avoid talking about individual securities because it just depends on the portfolio and what the objectives are of the people. So I don't want anybody to feel like they should run out and buy or sell either of these two. First, let me comment that Amazon and Google, along with Microsoft, have been able to grow dramatically this year, not because of their traditional businesses, but because of the cloud. More and more is going to the cloud, and those three companies have really captured a significant share of the cloud. So we've learned to do more in the cloud, and so it's likely to assume that these companies are going to continue to grab market share and continue to grow as more and more things go into the cloud and off of the desktop. Clearly here at ProVise, we're all working on laptops today, so we don't have desktops. Everybody's able to take their computers home with them and being able to work from home because so many of our applications are in the cloud. As it relates to Amazon, which is up rather dramatically this year, I think there's a couple of questions to ask. First of all, it's a great company. It's going to continue to grow. It's going to continue to do well, in spite of the fact that it might be overvalued at the moment. Just yesterday or this morning, they announced that they were getting into the pharmaceutical business, and some of the drugstore stocks took a significant hit. I think one of the questions is for for Amazon, is to maybe think of itself as the Walmart of the 2020s. You go back to the 80s. We all thought that as Walmart was putting more and more retailers, that one day maybe they would take over all of retail. Well, we saw that didn't happen. It's not likely to happen with Amazon either. More competitors are coming in. Other big companies like the drug companies, Target, and run down the list, have learned to compete with Amazon in the shopping space online. So it's likely to assume that at some point that growth is going to slow down. That doesn't mean it's not going to grow at a very good pace. It's just not likely to grow as much as it has been. As long as interest rates are down, the market's going to be supported by that and is likely to remain with some relatively high valuations. Future growth is going to be difficult because not only is the stock market up and got very close to 30,000 on the Dow the day before yesterday, but the bond market is also high with interest rates down as low as it is. So with that backdrop as to where we are, let me just comment for a moment about the next 60 days. Yes, he's a lame duck president, but there's still a lot he can do over the next 60 days. Some of it good, perhaps, and some of it might ruffle a few feathers. For instance, he could really push hard on both the Republican and Democratic Congress to try to get a stimulus bill out during the session, or much like he tweeted back in October when he said he was withdrawing his support for a stimulus bill and the market collapsed, we could find ourselves in a similar situation. He still has the ability to make rules and regulations that can't just be undone with the stroke of a pen. He can still make pardons of people for federal crimes. Some of them he's already done are quite controversial. And he can continue to blame China for the pandemic and add some additional tariffs before he leaves office. There's a lot that he can still affect over the next 60 days and leading into the Biden presidency. So with that, let me stop. And Susan, maybe you'll be kind enough to share some of the questions that we've got.
Sure. One of the questions was about the federal stimulus, but I think you covered that very well in your comments. So one of the questions I think that's on the mind of a lot of people is, how will President-elect Biden handle the COVID situation? We know that there's been, as you mentioned, some vaccine news, but there's still questions on distribution, timeline, who will, what will happen? And we know President-elect Biden's also put together a COVID team. So there's something out there called pandemic fatigue. So can the American people and the economy handle another economic shutdown?
So, Susan, I guess we can sum it up by saying that it's probably fair to say that a Biden presidency is going to be much more hands-on at a national level in dealing with it. He's repeated over and over again about listening to the scientists, listening to the doctors. A lot of people misunderstand. The president cannot order a national mask mandate across the country. That is left up to each of the individual states, to the individual governors. He can certainly encourage all of us much more forcefully than President Trump has to use masks, to socially distance, et cetera. But I think what you're going to see come out of this on a longer term basis is that, given the RNA that is being used for these two vaccines, there is so much more that we can do beyond the pandemic with this technology. And I think that you'll see a President Biden push hard in the research and development area for other illnesses, other diseases, where perhaps the RNA can be used in a similar way to what was done with this vaccine. Again, science amazes us all. The typical time to create and make a virus and to be able to have something with efficacy that is at least 95% apparently, is something in the 6 to 7 years range for a vaccine prior to dealing with the pandemic. All of this has occurred within the last 12 months. And so there's lots of other things. And in that regard, I think we'll see a lot of federal money going to research and development in the medical field as a result of it. From the fatigue standpoint, I think we all don't want to be socially distanced as we are today, that we want to see our friends, our family, that we want to go back out. I read an article this morning that close to 45% of the American public said that the pandemic has caused them stress, significant stress in their lives. It's probably caused all of us some degree of stress. There will be, I think, also a lot of effort placed into the mental health area by the Biden administration to help to deal with some of those issues.
Another question that always comes to mind is taxes and more taxes. So are there any winners or losers in the Biden tax proposal? Will taxes increase for people or for businesses?
Well, the good news is that unless your income is over $400,000, you are okay, at least according to the Democrat platform and all that Mr. Biden talked about, that he would not raise taxes for anyone who had less than $400,000 of income. For those over $400,000 of income, we, meaning us as financial planners and the population in general, are in a bit of a quandary over the next 6 weeks because we will not know the election results in Georgia until after the first of the year. We have to make a decision. Do we think the old rules, the rules we have today, are going to apply in 2021 and beyond? Or are we going to have a new set of rules? Are we going to raise the top rate from 37% to 39.6%? Are we going to, if we have over $1 million of income, if we're fortunate enough to be in that, have to pay regular, ordinary rates on capital gains and dividends, as was prepared for us in the Democratic platform? Excuse me. So every one of us has just got to look at our individual circumstances. But again, for anybody under $400,000, again, the promise, with quotes around the world, is that the taxes won't change. Of course, we can go back to that famous election in 1988 when Bush the first said, read my lips, no new taxes. And of course, he changed his mind over the 4 years he was in office. So I strongly urge everybody, visit with us, visit with your tax advisor, consider your own personal situation. At a minimum for this year, I would say to you that you want to definitely, as you should every year, do some tax loss harvesting, at least to offset any gains that you have in your winners with any losers that you might have. Allows you to reposition your portfolio going into the new year. Something that ought to be done regardless of what's happening with taxes. Consider the cost of selling now and paying a capital gains tax even at 20%. If your income is over 400,000, I keep putting that caveat in there because too many commentators have forgot to put that in. So if you're under that $400,000 limit, you don't have these issues. If you're over 400,000 or over $1 million, you definitely need to spending some time with your financial, legal, and tax advisors before the end of the year.
Great. The next question is a follow-up on the taxes. How about estate planning and estate taxes? Will they be impacted?
Well, again, it's Susan, it's going to depend on the Georgia election. Clearly, if President Trump had won, he had made it clear he wanted to make the 2017 changes to the estate tax permanent. I want to remind everybody they're not permanent. After 2025, the way the law was written in 2017, everything will revert back to the way it was prior to the Tax Act of 2017. So that the question around the estate planning is not just around the immediacy of perhaps Vice President Biden, he's got too many titles, President Biden advancing that to 2021 or 2022. It's thinking on a much longer term basis. It's a significant change in that under the current tax law, $11.6 million this year can be passed estate tax free by every individual. So husband and wife can pass over $23 million without having to pay any estate taxes. And if the old law were to come into play, that would probably, for a husband and wife, drop down to something just less than 50% of that amount once we adjust for inflation. So a significant change for someone who has a net worth over 10 or 11 million dollars. It's also fair to say that he's indicated that he would increase the tax from the current 40% to 45 or 50%, should he be able to push it through. But again, I want to go back to and remind everybody, think of your estate planning not just on these next 6 weeks, but further out. The other thing that would definitely happen with the Democrats in control as far as estate taxes are concerned is they are likely to limit some of the techniques that are used to lower the valuation in an estate, like a grantor retained annuity trust, a LLC, a family partnership, some of the other vehicles that are used for those that have significant wealth, therefore causing greater taxes. I have to tell you, the life insurance industry would love to see this go through and the law not be made permanent, because one of the only alternatives that people would have other than paying the estate tax out of their own personal estate would be to buy more life insurance. So if you think the estate tax laws are going to change in the near term, maybe investing in some life insurance companies would make some sense. One thing you should be doing under any circumstances this year is, to the extent that you are willing and able, look at doing annual gifting. Too many people overlook the opportunity to give $15,000 using the annual exemption to their children, grandchildren, the spouses of children. It can be a significant amount of money. Husband and wife with 3 children, adult children, and let's just assume no grandchildren at this point. You can give $30,000 to your son and $30,000 to his wife. You can give $30,000 to your daughter and another $30,000 to her husband. And the same with the third child. Effectively getting $180,000 out of your estate just by making those gifts. And you get to do it every year. More than that, Susan, people are also getting the growth of that money out of their estate. So if you're going to live another 10, 20, 30 years, that money, $180,000 that you might give away to the children today, compound that at a 7% rate, let's say, doubling every 10 years, 180 becomes 360 in 10, 720 in 20 years. And then over $1.4 million that you got out of your estate in a 30-year period of time. It's a very powerful tool that not enough people take advantage of.
Let's change gears a little bit and trade in China. President Trump, as you know, has taken a very firm stance on trading. And you mentioned tariffs may come into play in the last weeks of his presidency. Do you think Joe Biden will have a softer stance towards China and maybe towards our other trading partners, such as in Europe?
Well, Susan, I think a lot of people are going to be very surprised to see a President Biden be very strong on China, against China. He might have a softer tone than President Trump has, but Biden has made it really very clear that he sees China as a threat to the United States, stealing our technology, et cetera, taking advantage of the manipulation of currency, et cetera. So I think people are going to be surprised. Removing the tariffs is his bargaining chip. And if he does remove them and does not get enough from China, not just promised, but in reality over the next 4 years, there's going to be an awful lot of criticism at the new president as a result. What I think he's going to do, and I think it's really good from the standpoint of Europe, I think he will really try to patch up the relationship that we have with a lot of our European allies over the next 4 years. I think he will leverage that into the ability to begin to tear the tariffs down that exist with the European Union. Primarily, those tariffs have gone in as a result of subsidies that the EU has given to the airline manufacturers there. Of course, fairness, we've given some to our airline manufacturers as well. But I think what he'll do in that is maybe create a block to work against China on a united front on a go-forward basis. And if we can free up that trade, if we can avoid the manipulation of currency, that's going to be strong for the worldwide global growth. And I think that the new president is counting on that.
Good. So the market rebound, as you know, as you addressed in your intro, we've had the market rebound from incredible lows earlier in the year. So going forward, what do you think? What do you recommend from an investment perspective?
Well, the first thing I would say is there are 3 golden rules when it comes to investing money: diversify, diversify, and diversify. While it would look really smart to have put 100% of our money into 5 or 6 stocks on March 23rd when the market hit its low, and invested all of our money into maybe 10 stocks. Well, even throw Tesla into the mix, given how well it's done. There is a lot of risk that's involved in that. And over time, even though value stocks have not done well for several years now, and certainly have not participated in the rebound as much as the growth stocks have, over time, the two have a tendency to run a long race where they both end up in the same place. And so with regards to that, please don't go chasing this year's performance into next year. I mean, I don't think that we're going to see Amazon up another 70-some% in the coming year. Look at your risk tolerance, determine what your needs are, and invest appropriately to that. And as we talk with all of our clients, and particularly those that have accumulated money and are in retirement, don't take any more risk than you need to support your lifestyle. I mean, if all you need to earn is 6% to support your lifestyle on a go-forward basis, and you stretch to try to get 9 because you want to keep up with the Joneses next door, and you take that additional risk, and if that risk doesn't translate into additional value in your life, why take the risk in the first place? So continue to think long-term, continue to diversify. Don't chase this winter's. Think on a long-term basis. What stocks, what investments do you want to have over the next 4 or 5, maybe even 10-year period of time? Warren Buffett has said that in an ideal situation, you'd never sell a stock because you always would want to own it. It doesn't happen often, but that's the ideal stock to own.
Got it. So what about the healthcare industry under Biden's administration? We have COVID out there. Do you see any changes in that industry?
Well, clearly, if the Democrats take control of the Senate, there will be changes to Obamacare. We've heard much about what some of those changes would be, an expansion of it, maybe see Medicare go down to age 60 from current age 65. Lots of different things to occur. One of the things that I'm still fascinated by that nobody is talking about, Susan, is that back during the first 2 years of the Trump administration, the Republicans controlled the House, they controlled the Senate, and they controlled the White House. They didn't repeal Obamacare at that time. They could have, they had the power to do it, but they didn't. What they did do was to take away the mandate. I think they gambled that by taking away the mandate, that since that was the revenue that they were getting and the basis of the Supreme Court supporting Obamacare back in the earlier days, that it was a tax measure and that Congress had the right to tax, that without the tax, then Obamacare would be extinct. I think that was the political gambit that they said, well, it wasn't us that got rid of it, it's the courts that got rid of it. That's it remains to be seen whether that's going to happen or not, given the case that's before the Supreme Court now. So the change could be a negative one if the Supreme Court rules against Obamacare. If they don't rule against Obamacare, then I think, again, you'll see more money for research and development in using the technology to develop new drugs, new ways to treat illnesses that we have. I think that you'll also see in the healthcare arena some expansion of it, even without it, particularly as it relates to the COVID, more testing supplies, more PPP, more ways for people to be reimbursed for expenses related to COVID.
Okay.
I think that's something both the Democrats and the Republicans could agree on.
That's good.
Yes.
One other issue that sort of was a big highlight, not a highlight, but it was a focus, I would say, during the campaigning was the environmental issues, fossil fuels. So what do you think is going to happen in the fossil fuel industry?
I think the die is pretty well cast that we're moving away from fossil fuel, have been, and I think it's going to accelerate under a Biden presidency. He'll clearly be investing money into alternative sources of energy, but besides oil and gas. Today there was an IPO for a company that is going to be producing rare earth materials, which are desperately needed for batteries and the magnets for the batteries, for electrical vehicles, et cetera. There's automobile companies are saying they're moving more and more towards the electric vehicles. We've even seen the Hummer now, all things, that muscle machine that will come out in an electric version in the not too distant future. So I think that you're going to see a lot of money invested in that area. There's going to be winners and losers, and there's likely to be some really big winners, and there's likely to be some really big losers. So for anybody who's going to be going into that space and looking to invest in that area, you're going to have to really look deep into those companies and to the technology. I would also say that the energy companies, fossil fuel companies as we think of them today, might decide that they're going to just buy up all those alternative companies while they're still, quote, inexpensive, and buy the technology and develop it themselves, which some people would say, oh, those evil people. The other side of that is, as big as they are and with the money that many of them have, that could really hasten the development of alternative forms of energy. I wonder if we've got any additional questions that might have come in from our viewers today.
Yes, we have a few questions from the audience. I'll begin with the first one. Do you foresee any changes being made to Social Security, especially given the increasingly large national debt? We've written for years about the need for reform in Social Security. Right now, it's anticipated that Social Security will run out of money in its trust fund somewhere in about the next 15 years, depending upon who's measuring it, maybe as early as 2033, currently projected by Social Security itself at 2035. We've talked about there's only a few ways that you can do that. You can increase the taxes. Nobody likes that. You can cut the benefits. Nobody likes that. Or you can do nothing, which is what Congress has done for the past couple of decades, knowing that a day of reckoning is coming. You can also raise the age at which it starts, or which you'd be permitted to start it. And Congress did half of that a few 15 years ago or so now, where they raised the age to get the full retirement from 65 to 67. They left the lowest age at 62. There's the possibility that that could get raised. That's another way to get there. Vice President Biden, as he was campaigning and in the Democratic platform, proposed that the base level, if you will, which next year will be just shy of $140,000 of income, that it be taxed up to $140,000 of income as Social Security. And then there would be, nothing would be taxed until you made $400,000 or more. And then the tax would kick in again. And anybody who made over 400,000 would be contributing more, but wouldn't get any of the benefit of that. It would just contribute more money. So there's kind of a donut hole that existed between the base level and the 400,000. Now, what's going to happen if that were to come to play is the 400,000 under the proposal was capped, so it's not going to be adjusted for inflation. Where this number, the $140,000 number, would grow every year. So the donut hole would keep getting smaller and smaller and smaller and smaller over a very long period of time. Keep in mind that not only do those who make over $400,000 have to pay the money into Social Security and Medicare taxes, but it has to be matched by corporations. And if corporations have to match that additional tax, it's going to reduce their earnings, which will slow the growth of their stock, which will slow the growth of all of our portfolios. But let's face it, continuing to do nothing is the null alternative, and it's unacceptable. They're going to have to figure out a way to compromise and to come up with something to preserve Social Security.
Perfect. We have a few other questions from the audience. This one touches on the national debt again. Given the ballooning national debt, do you foresee any other negative effects on the markets or our portfolios as well?
You know, debt is, when we're moving towards retirement, most of us have this vision that one day we don't want to have any more debt. And that's not a bad vision to have. People want to pay off the mortgage, don't want to make any more payments to the bank. But having a reasonable amount of debt within your financial plan at an individual level, within a corporate level, or within a government level is not a bad thing. The issue that we have with the national debt at this point is that it's beginning to represent such a large percent of our gross domestic product. And the question is can we continue to pay the interest on that debt, let alone be able to ever repay the debt? We've been building on that debt. We just wrote our ProVise bullets about this. There have been very few years since the Second World War that we've had a surplus in government spending rather than spending more than the government takes in. As long as interest rates remain at the current level, the government probably will be able to continue to handle the debt load. The concern is that if the economy goes back to a new normal, meaning like the old normal, where a 10-year treasury isn't paying an interest rate of 80 or 90 basis points as it is today, but it's paying 3 or 3.5% interest. That extra interest that we're going to have to pay on our debt is going to cause us to spend less money on goods and services through the government. And so it could have a very negative effect as those interest rates are going up. However, keep in mind that the government has what nobody else has. That's a printing press with paper and with ink. And if they need to, they can print more money. The negative impact of that, of course, is put all of that cash into the system, and it's likely to cause some awfully big inflation. It's going to have to be a very delicate balance. Right now, it's okay, but it's going to have to be carefully looked at as we go forward. And again, future Congresses and this president is going to have to grapple with that subject over the next 4 years.
Great. The next question touches on portfolio liquidity. Given the low returns now available in CDs, what do you recommend as an avenue for keeping our portfolios relatively liquid?
There's just no answer for it. In the way we used to have things that were liquid. Some of us are old enough to remember the days of being able to get 20% on our money market funds. And some of us remember the days when we were delighted to get a mortgage at 14 or 15% on a 30-year mortgage. And in those days, CDs were paying 15, 16%. Those days hopefully are a long way behind us, because in spite of the fact that they sound good in some ways, there's a lot of inflation that was going on in our country, at that time. Today, there is no place to hide your money and get any kind of a reasonable return if you need the money to be liquid. The best thing that you can do is make sure that you have a good emergency and opportunity fund, and that you do try to seek out the best return that you can probably get from your local bank or from a money market fund if you're comfortable doing that. But the more you stretch for that yield, the more you are jeopardizing the principle of your quote unquote liquid investments. And if interest rates were to rise quickly, as I commented earlier, bond prices would come down. And struggling to find a rate of return that's acceptable is a struggle, and there is literally no answer to it unless you're willing to take some pretty significant risk with your liquid investments.
Perfect. Given Biden's propensity to lean towards global economic unity, should investors rebalance their portfolios in favor of international or domestic securities?
I think most of us that are living here in this country are best off in having most of our money invested here in the States. I said earlier, the three cardinal rules are diversify, diversify, diversify. And clearly having the bulk of your money here, I think, makes a lot of sense, but not to the exclusion of investing outside of the United States. The European markets have not had the growth that we've had back this past year. So there's definitely some opportunity that's there. China has rebounded very quickly as well, and is probably a little on the pricey side itself. Other emerging markets might make sense. Just this past week, many Asian nations entered into a free trade agreement that stretched from New Zealand up all the way up through Southeast Asia and into China. That should definitely be good for trade in those countries. Yes, invest some of the money overseas, but have the bulk of your money invested here in the States.
Great. With the push for the raise in minimum wage and Mr. Biden's explicit desire increased union involvement, do you see a slowdown in economic growth in the near term?
So we have some people who are in today watching who are not from Florida. Here in Florida, we amended our Constitution to increase the minimum wage over the next 5 or 6 years from currently about $8.50 an hour up to $15 an hour. And that will start next September. It'll go up $1 a year until it gets to $15. There is a huge push across all of America for increasing wages, whether it's teachers, whether it's workers here in Florida in the hospitality industry, et cetera. And I would point out a couple of different things. First, we, the consumer, are going to pay for those increases. The retailers, the hotels, the restaurants, the service companies, whoever it is, will have their margins compressed. And the only thing that they can do is either make less money, which will lower the stock value of those companies, or try to find a way to pass those rising costs on to the consumer. And clearly, most companies will try to do the latter. So you can expect over time the $8 hamburger with French fries going to increase in cost to adjust for that pricing change. The second thing I would say is that it's our belief that commodity inflation is temporary inflation for the most part. It moves up and down, particularly true in the energy and in the food arenas. The greatest form of permanent inflation, and only once in my lifetime have I seen this not be the case, is in wage inflation. And the one time that it didn't occur and there actually was some deflation in wages that occurred was back in the financial panic of 2008, 2009, where a lot of people took some significant pay cuts in order to keep a job. So rising wages has in the case in many situations as a yin and a yang. The yin is I've got more money to spend. The yang is it's going to cost me more to buy some of those things that I'm now able to buy. So again, if there's a balance that exists there, it's great to get people up to what is often referred to as a livable wage.
Perfect. Do you believe the higher tax rate on people earning over $400,000 will have a negative impact on the market and GDP?
So raising taxes in general is usually a negative to any economy. Pegging the number at $400,000 of income, however, it is probably going to cut into the disposable income that some of those folks have, but more likely will cut into their savings. And that reduction in savings is generally going to be considered a negative for the economy. So yes, there will be a negative effect in that regard. And again, that's the yin and the yang, the push and the pull of all of these decisions. There are always winners and there are always losers. And what one has to really be careful about is the law of unintended consequences that often occurs.
Great. We have a couple more questions to address. Are there any market sectors that you see outperforming the overall market during a Biden administration?
Well, technology is here to stay. I think it's going to continue to grow. I continue to be surprised and marvel at the minds that create some of the technology that we've seen. It's not going to leave our life. It's only going to become a greater part of our life. I mean, so here we have a computer that's more sophisticated than what sent the men to the moon back in the 60s. And think about when we first got this device, how big it was, how clunky it was, how little it could really do. And talking on it wasn't extremely reliable. So technology is going to continue to drive us forward. In the short run, I think the rotation that we're starting to see into the value sector over this as we perhaps have a vaccine that will quell the pandemic. So consumer staples, financials, some of the cyclical stocks, those that are more value oriented, who have not participated in the rebound like some of the growth companies have, I think you're going to see over the next couple of years are going to participate in a much greater way than they have in the past. Again, I'll go back to diversify, diversify, diversify. I know I'm getting boring by saying it, but it's a cardinal rule as far as we are concerned.
Turning things back to Florida, do you foresee any changes in Florida state tax law?
Well, clearly we'll not have an income tax, not unless 60% of us are willing to vote for a constitutional amendment to put an income tax back in. I think some of our fees for some of the services that we get from government are likely to go up. The state is grappling with a loss of some $5.4 billion of revenue loss. So clearly, we're either going to have to raise new revenue, cut services, or or spending money, or some combination of the above. So I think tax rates at the state level might go up. Right now, particularly here in the Tampa Bay area, where housing has been so strong and the prices have gone up, the taxes have gone up, although the millage rate for the most part has not gone up very much. I'd also point out that there is a willingness on the part of the electorate to absorb more taxes if the money is spent intelligently. As an example, here in Pinellas County, the voters substantially said that they would tax themselves an extra half a penny to have that money go towards education. And there were lots of tax bills across the country, in blue states and red states, where taxes were raised and the voters said, okay, we think this is a good use of spending the money. It's likely that we will see some increase, but it's clearly not going to be anything on an income tax level, nor an inheritance tax level. We got one question that came in that I've got here on the desk that I promised I would address. And that was, somebody said that the Democratic platform said that the new tax that they would put in on capital gains would affect capital gains on individual homes. Currently, any single homeowner can not pay any capital gains tax on the first $250,000 of growth in the home, or $500,000 as it relates to a couple filing jointly. And there's some people who are saying that that's going to go away and you have to pay a 40% tax. That is simply not true. It's one of those rumors that got started. I'm not going to call it fake news, Susan.
Social media, it kind of got a handle on social media.
So that's absolutely not true. It's not in the Democrat platform. I'd be shocked if anybody was silly enough to propose that, because, as I mentioned way back in the beginning of our webinar, the housing industry is one of the strengths right now. And if that kind of a tax were to be put into housing, housing growth would fall off dramatically. New houses being built, people moving, they just wouldn't want to pay the tax. So it's absolutely not true.
Thank you.
Let's take one more question.
We got one more question. Ray, the 10-year Treasury rate has ticked up over the last few weeks. Do you have any thoughts on whether that continues to trend towards 1%, or do you think it settles back over the balance of 2020?
So one of the reasons that interest rates are so depressed is that the Fed, with its unlimited checkbook, is writing checks to buy all of the debt that's out there, or as much as they think is appropriate, I should say. If they want to depress short-term interest rates, they can just go buy a whole bunch of 10-year notes, and that will depress interest rates back down. Again, with the advent of growth coming in the near term, particularly now with 2 vaccines announced, more vaccines expected, the availability being mass produced to be able to provide to lots of people, not just here in the United States, but around the world. There's a lot of pent up demand that's there. And if people go out and start spending a lot of money again and start driving prices up, and we start to get growth again and get some inflation, interest rates are liable to drift up. Are they going to go up dramatically? I mean, again, let's remember a typical range for a 10-year Treasury in the old world was 3.5%, maybe even a little bit higher than that. So there's a long way to get back to normal. So getting to 1% may sound like it's really good when it was only at 70 basis points a few weeks ago. But as the market goes up, as the economy improves and is expected to improve, it is likely that interest rates will go up. Don't think they're going to go up dramatically over the next couple of years, because the Fed has made it clear that it's going to be aggressive in trying to keep interest rates down. Don't forget, the Fed has already said that their target of 2%, they're okay if it goes above that for a sustained period of time, because we have lots of years behind us where it was 1.5%, 1.3%, 1.8%. And they said it'll be okay for us to make up for that, so that in aggregate, we get back up. So with that future growth, we'll probably get some inflation, some rising of interest rates, but don't think we'll see anything dramatic over the next couple of years. And my cracked froggy crystal ball just doesn't work much beyond that. So Susan, thank you very much for hosting us today and for asking the questions. Appreciate it. We appreciate the voice of God from Oscar. Someday we'll let you see Oscar. But just want to say to everybody, thank you very much for being with us today. Hope that you found this to be helpful. Whether you're a client of ours today or not, we encourage you to reach out to your advisors between now and the end of the year and early into next year. Take some of the things that we've talked about, apply them to your own personal situation, see how they might fit. And I want to thank you for being with us. We will be sending everybody who is in today a link. We had some questions we did not have time to address today, so we'll promise to try to address those when we send out the link or soon thereafter, so that you have those. Share the link with others that you know. We will be making it available to anybody who was unable to be with us today.